The Congressional Budget Office has issued a startling new report on the United States ballooning federal debt and what financial consequences could lay ahead for future generations. And Yahoo Finance's Aarthi Swaminathan joins us now to discuss. Did I say your last name wrong?
Swaminathan, it's fine. Myles always gets it right.
Oh, Myles.
Oh, there it is. Yes.
Of course he does. Okay, so talk to us about the details of this recent report and the CBO's projections for the U.S. federal debt. I mean, we all know the debt's
crazy.
out of control,
yeah.
But just how crazy is it?
Okay, it's crazy. So by 2049, 30 years from now, we would have spent so much money on Social Security and healthcare that debt to GDP will reach 144%. That's not just crazy, it's scary to some people. I mean, I spoke to some people who said that, this is going to have a huge impact on the economy. This is going to hold back, economic growth. I know you're looking at me. There are two perspectives to this, but let's hear this side first. The people I talk to say that it's going to dampen economic output, all this interest that when you borrow something, you have to pay interest, it's all going to increase. And then who's going to pay back? U.S. households. And then, really far down the line, you might even see a loss of sovereignty because all this interest is being held by foreigners. What if you're no longer like the best building on the block? People might lose interest in U.S. treasuries. What happens then? What happens then, Myles?
Well, have you heard of a little thing called MMT?
Look,
Here comes Myles.
I mean, the thing is, when Aarti's outlining all the experts who believe this is a major problem, she includes Jay Powell in that, right? Because Jay Powell has mentioned casually, right? He says, this is the thing everyone knows. The sustainable, the fiscal picture in the U.S. is completely unsustainable. Problem is, the U.S. prints its own currency. Interest rates have shown that the appetite for U.S. debt, particularly from foreign investors, U.S.-based pension funds, so on and so forth, institutional investors, remains quite robust. So there's clearly not a market concern on this fiscal picture. And I think the notion that the notion that this is some kind of thing we can't pay for in the future misstates willfully how we actually pay for the government expenditures in any one year, which is that we pay for them. That's just it, right? We just decide what the number is, and then the Treasury writes the number down, and then that's it. And then the revenue we collect from taxes, the shortfall in revenue we collect is the difference, right? That's the deficit. But the deficit itself doesn't need to be paid down, strictly speaking.
What would some of the people that you spoke to think about this idea?
No, I mean, it is interesting because the last time you had debt this high, 106%, World War II. What happened then? Truman kind of scaled back all these problems. Politically unpopular, but he had a strong mandate. You came off a world war, you won the world war. But at this point, one of the experts, who is a longtime DC operative, he is a Republican, and he says that political polarization over the past 15 to 20 years is going to complicate any solution. So, obviously you're going to spend more, you're going to earn less taxes. Somebody has to pay for this. Consequences will come about, but obviously not maybe in the next 10 years, but in the next 50 years, 100 years, maybe your great-grandchildren will be paying for this. So,
well, I mean, I don't agree with that construction that a lot of DC types create, because it's not like you have a bill at the local diner and then eventually you have to pay that, right? I mean, imagine that you had a bill at the local diner, but you printed your own currency. So then you just decided how much you wanted to pay it or not pay it and said, well, I can print as much currency as I want in the future, so don't worry about it right now. The other thing is we've already been paying, in theory, this debt right now, because if our fiscal stance, which hasn't been particularly accommodative since the crisis, we didn't do as much stimulus as we should have after the crisis, that lack of stimulating the economy is paying for the debt now. So the deficit, in a way, is just an accounting identity, but the actual social cost of pretending like we can't spend as much money as we should to stimulate the economy is, in fact, a version of paying for the deficit. So we've already been paying for it, and I just think that the whole kind of, fiscal budget hawk thing, which many hawks are now rethinking, maybe they've wasted their life's work kind of acting this way. I just don't think that it is exactly in these terms.
So you can spend your way out of it. You can stimulate yourself to grow, to inflate.
Yeah, what about inflation? I mean,
cut your inflation. Can you inflate your way out of it?
All these people, so many of these deficit hawks, right, are the people who in 2013 said, we got to do austerity, right? They got it. Guess what? 2018, they said, got to cut taxes. What was that? That was stimulus you didn't pay for. Then they had economic growth, and they're like, do more of this. So what is it really? What are we really talking about? We're talking about political choices to punish certain people. We're not talking about actual fiscal sustainability.
Right, but that there are answers that could
spend more money.
Spend more money, grow yourself. If you go back to World War II, you need growth, you need inflation, and these things go away. That's what you still need to get that.
Yeah,
we haven't had any of that. Maybe the CPI number will be more illuminating this week. Aarthi, thank you so much.
Thank you.